Hello, Tammy. How are you today? Thank you so much for joining your small business podcast.
Thanks, Janice. It's great to be here.
That is awesome. That is awesome. Just so glad you could join us and take a few minutes out of your busy schedule to come onto the show. So, of course, we got to start out off with you telling us who you are, what you do, and how your entrepreneurial journey has taken you to where you are today.
Sure. Well, my name is Tammy Trenta. I'm a wealth manager. I own a company called Family Financial. We are a family office of sorts for business owners. And my journey in entrepreneurship, uh, it's pretty recent. So I was a partner at my last firm and I launched my company the beginning of this year. And it's felt very organic. So it makes me wonder if I should have done it a long time ago, but everything happens for a reason, right?
Right, right. So you started in January then?
That's right. Yeah.
Wow, that is amazing. Here we are. Well, I think tomorrow is the first. So you got 5 months that you've been
That's
in
right.
it. Yes, yes,
Yes.
yes. So why did you want to get into the financial business in the first place?
Well, I've been in the financial business for 26 years.
Mhm.
And so that's not necessarily new for me. And the industry, I would say, found me. I grew up on the East Coast, middle class family. And when I attended my first year of college, I got a phone call from my parents saying they were getting a divorce.
Mm.
The college money that they had saved for me somehow evaporated, and I had to take out student loans and figure things out. And it was an interesting time in my life. I think for anyone who's a student, it's a period of time where you're just learning how to become independent. And maybe that transition happens over a period of years. And for me, I just woke up one day and was on my own. So um, I had a lot of questions of how things happened. My parents both ended up filing bankruptcy. Their divorce took 8 years. And I had always planned to be a lawyer. So I had taken the LSAT, I had submitted um, my application for law school. And I think upon graduating from college, I really had to think about what my next step was. And do I want to continue to invest a lot of money in education if I wasn't 100% convinced that that was the field I was going to pursue?
Mhm.
Not a lot of friends of mine who were lawyers were passionate about their job. In fact, the opposite. And so, I was lucky enough to get an opportunity to work at a large brokerage firm in my early 20s. And that made me think about how great it would be to understand how to manage my own money so that what happened to my parents didn't happen to me. And so I believe I entered the business for selfish reasons, but the side effect was that, I get the privilege of helping other people now. And that's what I really love the most.
Definitely. And I wouldn't even say selfish reasons. I mean, because this is something everyone needs to know how to manage their money, how to save money, how to budget, how to invest. So, really, I mean, it wasn't selfish. Everyone needs to know. But, like you said, now you can take what you have learned and help other people, other families. So that's what's
Exactly.
incredible about it. So again, you do assist small businesses and families, correct?
Yes.
Um,
Hmm.
to keep more of what they earn, preserve and grow their wealth by teaching them how to reduce their taxes. So tell
Hmm.
us, what are some of the most common mistakes business owners make when it comes to their taxes?
So it's a great
A
question,
broad
and it's a
question.
broad question.
Yeah.
Yes.
Or
But
some of the
I
common,
would,
just a
I
few.
would say that most most individuals who start a business, I would say the majority of them don't have a financial background.
Hmm.
They're starting a business because it's perhaps something they're excited about or something they want to do or explore, and they have an idea, right? And we know that an idea is 99% perspiration, 1% inspiration. So there's a
Mhm.
whole lot. You better be really passionate about that career or that business to allow you to continue to work in that business. And so I think one of the most important things is to have a plan and to figure out, well, if I'm launching a company, what is my capital investment? How much money I'm going to need? How much do I have? Do I need to borrow? Do I need to offer equity? What are my investors' return on their investment? And so you might say, well, I'm providing a service, and so I don't need a large capital investment, or I have, enough to start my business. But the money question is oftentimes the biggest.
Mhm.
The money in terms of how much is it going to cost? And then the second biggest question is, what about when I break even? And so for people who are just starting out, I think those are really important questions that, we need to ask ourselves. Now, beyond that, business owners will get to a point where they've been working with their tax preparer for a while. They may or may not have a financial advisor, because oftentimes what I see is business owners are many times investing more and more into their business. They're not paying themselves, is
Right.
what I like to call it, taking some money off the table and saving for yourself. And so if they don't have a financial advisor and they just have a tax preparer, then they're really not availing themselves to all the different things that are out there. And remember, like most people who start are not financial people.
Mhm.
Now, that said, I started a business in 2005, and I was a financial person. And I will be the first to tell you that I had a level of confidence that, well, most people don't know about money, and I do, and I'm going to be ahead of the game. It was still hard, and I still
Right.
made a ton of mistakes. So while that helps, it's not the be all end all. Um, the clients that I work with are oftentimes writing six-figure checks to the IRS.
Mm.
And there are a lot of different tips and tricks that you can learn to work within the IRS rules and all of the laws, to be able to keep more of what you have, as an individual and as a family.
Mhm.
But I would say by and large, if you are a successful business owner and you feel like you're writing a pretty big check, it might be time to just think about the team that you surround yourself with. Um, there's a big difference between a tax preparer and a tax planner.
Mm.
Um, for some perspective, there's about 1.4 million tax preparers in the US.
Wow.
And for every tax preparer, there's about 71 households for that tax preparer. So that's a lot of
Wow.
tax returns that are being done at a very specific time in the
Mhm.
year. And I think many of our clients, many people in general, expect that their tax preparer is also going to help them save money in taxes.
Yeah.
And that cannot be farther from the truth for two reasons. One, they have too many clients trying to get things filed, so they are looking in the rear view mirror. They're
Mm.
looking backwards saying, okay, I'm a historian. What happened last year so we can get this submitted and you filed on time?
Mhm.
If you're looking for tax planning, there's statistically only about 1,000, maybe more at this time, but not many more tax planners.
Mhm.
And tax planners are looking forward. And so you really need someone who's got both of those skill sets to help you to keep more of what you earn. And at Family Financial, I'm an enrolled agent, so I can prepare returns.
Mhm.
Um, and I'm a certified tax coach, and I have a tax preparer on my team.
Mm.
So, between the three of us, well, I guess the two of us, because I have two of those roles, and I'm a financial advisor, certified financial planner. So
Mhm.
I guess I would say I'm the big picture person. I'm the quarterback. I see all of it, and I'm a
Mhm.
generalist. And then I collaborate with my tax preparer and me as the tax planner to figure out what those strategies are.
Okay. Yeah. Well, let me go back on two things. Two things you said. One was the fact that, as far as entrepreneurs, we have that idea, and we're not thinking about money, taxes. We're not thinking about any of that. We're just trying to get that idea into fruition and make it a business and make money. And then after the fact, it's like, oh wait, I gotta pay taxes.
Yes.
And that's where that disconnect is with the majority of people right now who are owning running their own businesses. They don't even think about that. It doesn't even,
Mm-hmm.
you're just so busy trying to push your idea
Yes.
and make it
Well,
your.
and another thing that I see that's very common, especially for business owners starting, is the commingling of their personal
Mm,
spending with the business spending. And that gets tricky because, well, the IRS has definitely some triggers when they look at a tax return and decide who's going to be audited.
mm-hmm,
And if you know what those triggers are, you can keep yourself safe or as safe as possible.
mm-hmm,
But when you start combining and what you have, what I call Schedule C income, right? You haven't formed a corporation yet. Maybe you just have a DBA and that money flows on your personal tax return. If you're taking a lot of deductions against that business income and you're not showing profit, that's going to be a red flag. And so how do you, if you are the person commingling a lot of your personal expenses, you should be prepared that you'll get a visit to your house from an IRS agent and they're going to want you to justify those expenses. And I am sharing that from personal experience, um, that you need to be careful if that's what you're doing.
that
And
sounds so
so
scary.
yes, yes.
Oh my gosh, I would
I've
just
had it
pass
happen to
out.
clients too. Yeah.
But you're right, because like I said, that's one thing that a lot of entrepreneurs just don't think about. But luckily, we have people like you that say, "Hey, let's get a hold of this because you don't want to get audited and don't want to pay all most of your income in taxes because you haven't been and all that stuff." Oh my goodness, yeah, that's a little scary.
Well, and let's be honest, the last year we've seen a very large wave of transition from being a W-2 employee working for somebody else
Mm-hmm.
and becoming self-employed, whether that's through, the gig economy or someone just deciding they're going to become a consultant. But that shift, there's a lot that comes with that shift. And it's easy when someone's paying you directly to see that money coming in, but at some point you have to file your tax return. You
Mm-hmm.
have to figure out what deductions are allowable. And when you're not thinking about that, you get that surprise in
Yeah.
April. And no one likes surprises. So we like to meet with clients at the end of the year before the filing deadline, because if there are things that can be done, I would say 90% of those strategies need to happen before the year closes out.
Mhm. Okay, okay. And I know one thing about um, the whole tax thing, especially when you have your own business, is the home office. Like everyone now has a home office, especially if you get on Pinterest and you look at all those. Like everyone has a home office. How does one qualify for the home office deduction? Because I know some people, they might use a corner of their bedroom or a corner of a room to have a home office, or they have a entire room dedicated for it. So, what are those qualifications to
Mm-hmm.
have that deduction?
So that is a great question. And let's start off by saying the tax code is very antiquated. Okay, so let's just lay that out. If you're working from home, in 2017, there was laws that were passed during the Trump administration that disallowed anybody who is a W-2 employee to deduct home office expenses.
Hmm.
So if you're, and now that was before COVID. COVID happens, and the majority of the
Mhm.
world is working from their kitchen, or if
Right.
they're lucky, they have an office. And that becomes trickier because the code was never changed to accommodate anybody working from home. And it's kind of a point of contention right now. If you have Schedule C income or you are self employed, then you are able to take the home office deduction. Now, again, I'm sitting here in a dining room area.
Hmm.
This dining room is used for people to eat
Right.
and do whatever. Kids could do their homework here, but if this is not a dedicated office space, then technically, according to the IRS, I can't use it. So the best way to get the home office deduction is to identify a room in your house. You measure the square footage of that house relative of that space relative to the entire house, and then you can prorate some of your other expenses related to the house to get that home office deduction.
Okay, because I know a lot of people have those questions. I'm in a few business groups, and that is one of the main questions is how to write off their office. 'Cause like I said, there's some people who only use like a corner of their bedroom. So technically that's not an office. They can't write that off.
Yeah,
Right.
yeah,
Wow.
no,
I'm
it's
actually one of those people. I use a corner of my bedroom for the office, and I work from home with a W-2 job and then my own business. So it's like, what do you do?
well, it's a really valid point.
Mhm.
The IRS code hasn't evolved on that. In fact, I have a an influencer client who works from her kitchen. They're
Mm.
constantly shooting. She's a registered dietitian. She prepares
Wow.
meals, and that's her workspace.
Yeah.
But in the IRS's eyes, they are not looking at it that way. And so it is very interesting. Now she has a corporation, so the when you are a corporation, the audit level lessens. And so that's one of the reasons why people, once they gain some success, might decide to form their own corporation as opposed
Mhm.
to remaining Schedule C. And there's self-employment tax that Schedule C earners need to pay that can be different in a corporation. However, if you decide to set up a corporation, you have to figure out what the expenses of doing all of that are. Now you have to pay the expense of incorporating. You have a second tax return that you need to pay to have prepared. You may need to run payroll. And
Mhm.
so it might be $5,000 or bookkeeping. And if it's costing you that much, you've got to make sure that the cost um, that it's worth the cost to do it, that you're going to save more shifting from Schedule C to having a corporation.
Yes, I have a recurring guest that comes on the show, and he always talks about S corps and saying
Mhm.
S corps is one of the best entities that entrepreneurs and small business owners can file, but it's just you don't hear a lot about it. You hear more about
Mhm.
LLCs more than anything. So when you
Mhm.
came on the show to talk about S corps, I actually had to do some research because I was like, I have no idea what this says. No
Mhm.
one knows.
Yeah. Yeah. Well, the LLC in every state is different.
Hmm.
I believe you're in Tennessee. I'm in
Yes.
California, and California loves to take your hard-earned money. We have one of the highest tax rates in the country,
Hmm.
but if you form an LLC, you still have, or a corporation, you still have an $800 franchise tax board filing fee every year. And that's not the case with every state. So even if you make no money, you have to pay $800 in tax. And so it's the you can also be an LLC and make the S election to be treated as a corporation. So it can become complicated when incorporating, but it doesn't need to be. In my mind, in the simplest way to think about it, if you have $100,000 in revenue in Schedule C income, which is flowing to your personal return, and you're deducting 100,000 in expenses, that might trigger an audit. If you have the same revenue and you're a C corp or an S corporation, they're probably not going to look at it, because the auditors for the S corps are usually, they have a higher sophistication level. They aren't looking at, they're looking at the people who have millions and millions coming through the S corp, and not hundreds and thousands.
Okay, I have to look into that. Really have to. And we touched on one thing I wanted to talk about. Was I actually did some research on someone that I think every year they were filing that they had business losses. Something like how you were saying about if you make 100,000, but you write off 100,000, so that's showing no profit at all. But they were doing that year after year, and then they got I don't know if they got a letter in the mail or some kind of notification from the IRS saying that basically now it looks like a hobby. So maybe then they can just not even have this as a business anymore. So from what I did from the research, it's like 9 factors that they look at to determine things like that. What are those factors that the IRS looks at in case they see your business as a hobby? What are those factors? Because I know some people definitely would like to know this, because especially for those who are just starting out in their business, and they might think that they're not making enough money to count it as a business and all of that. So what are those factors that the IRS is looking at that they could say, this is just a hobby. You don't even need to be doing this.
Yes. Well, I don't know what specifically the 9 factors are, but I can tell you about what some rules of thumb are in terms of how the IRS views. Now, anybody who starts a company, it is rare that someone is going to make money in their first year. And so the IRS tends to give you a pass in the first few years of having a business if you continue to show losses, right? You need time to ramp up the business. Once you get to year 3 or 4, if you're still showing losses, that's when the IRS looks at it, and they may say, okay, we're going to have to take a closer look at this. Is this really a business if you continue to lose money, or is this a hobby? They need to see you starting to make money in year 4 and going forward, or else they'll disallow it and classify it as a hobby. So that's, I think, one of the great things about having a business when you are starting out is that you can, let's say, in your case, Janice, you have income and from working, W-2 income, and let's say you've got, income from the podcast business. Which one, if you can create a loss in the podcast business, that's going to help you offset the tax that you pay with your W-2 income. You can only do that for so long until the IRS looks at it more closely. So it's a short-term thing, but we see it a lot where someone starts their first year and maybe they spent $100,000 on starting their business. Is that deductible? Yes, but it can only be deductible up to the amount that you put in to the company. And so it can get tricky, but I would say clean, just to think of it cleanly, if you're showing losses for more than 3 years, you might need to rethink that if you don't want to get a notice from the IRS.
Wow. Yeah, that's very interesting. Because I, of course, being in this field, I've have talked to people who have said, I didn't make a profit till year 7, year 8, but they were still filing taxes. So it's kind of like, wow.
Well, they also want to see revenue coming in. So that is probably one of those 9 things, I would assume. If the IRS looks at revenue growth every year, that's a lot more promising than if you have 10,000 in revenue, but you're showing 50,000 in losses every year,
Woo.
and that revenue never really seems to move.
Yeah, yeah, that's not good. That's not good at all. So what are some deductions that most don't even think about when it comes to writing deductions off for your business? Are there some that some people just some common ones that we can
Mhm.
actually use that we never even think about?
Well, I would say retirement plans, I think they're a great deduction. And, this to me comes down to the whole idea of, people who start a business are not necessarily financial people, but it's tricky. So if you do have profit, you can use a retirement plan to shelter some of that income.
Mm-hmm.
I've also seen, uh, you know, business owners employ family members. That's another way, um, and give them retirement plans too. But
Mm-hmm.
it just depends on how much profit there is. What I love, I call it my ace in the hole, is the I-401k. So 20 years ago, this was not available to, someone who's an independent contractor. It They only had 401ks for, large corporations.
Mm-hmm.
And about 20 years ago, they came out with an individual 401k. So you could go to a Charles Schwab or a Fidelity and set up an individual 401k. If you only made $20,000, you could shelter the whole $20,000 in the form of an employee deferral.
Hmm.
When you're Schedule C, though, the downside to Schedule C is that you still have to pay the self-employment tax.
Hmm.
And the self-employment tax is basically your Medicare tax and your Social Security tax times two. So Medicare is 1.45%, and Social Security is 6.2. You double that, you're at around 15%.
Mm-hmm.
Even if you pay no federal and state tax, you're still at
Right.
15%. So
Oh.
um, that you're really not going to be able to get around. The only way to get around that is just to not show any profit. But any profit that you do show, even if you shelter it in a retirement plan, is going to be subject to self-employment tax. If you become an S corp, you can pay yourself a wage, and you can separate out what your W-2 wage is with the amount of profit that you make. So you're not
Mm.
by default taxed on all of the profit plus your wage. You're able to separate it out.
Those are some good points. I hope people are taking notes as they listen to this today, because that is some awesome points that we all need to implement into our taxes. And you actually hit on one point. One question that I had was asking, getting your family members to work for you, and what was the
Mhm.
benefit of that? Because I know a lot of people say that, oh, instead of hiring so and so, hire a family member. So, what are the benefits to that? Hiring a family member versus just a regular employee that you don't know.
Yeah. So um, let's say you have children
Mm-hmm.
and you're working from home, and you can actually, children have to have work permits, right? They can't just be any age, and if they are young, you've got to get an exception. Like, let's say they're a child entertainer or something like that, maybe that's a
Mm-hmm.
little bit different. But you have to be a certain age to be able to work. Once you have a work permit, you can hire your children, and you can pay them up to 12, I want to say it's like $12,400
Mm-hmm.
each, and not pay any tax,
Okay.
federal or state tax, because they're below that standard deduction. So that's something common that you see. I see parents employing their children, and now they have earned income, they can do a Roth IRA. So that's another technique that can be implemented. So when you're capturing employees at the lower to no tax rate,
Hmm.
It's a way of income shifting to people. They have to have a job, they have to have something that they do, a job description, and a way of them contributing. But yeah, that's definitely a way that you can keep more of what you earn, especially when you're supporting your children oftentimes anyway.
Yes, definitely. A lot of the money you paying them is really you're gonna give to them anyway.
Right.
I know my husband keeps telling me that I need to hire my one of my daughters. She's only she'll be 14 in a couple months.
Hmm.
She's like, you have got to use her. She needs to be your VA. And I was like, I don't know. But yeah, I was wondering what that benefit is versus hiring just anyone else. But it's
Yeah.
definitely a good point.
I
Definitely.
mean, you do have the expense of them filing their own tax return,
Hmm.
but the standard deduction now for everybody is, if you're single, it's 12,500. So nobody pays tax on that money.
Okay. Yeah, I had no idea about that. Well, this has been such a great, informative interview. I don't want to keep you long because I know you're on your retreat and you're about to go play golf. So I'm going to skip the game that we play. We usually play like a this or that real quick game, but I'm going to skip it this time because I do not want to hold you up. Do you know how to play golf?
I do, um,
Oh.
but it's not pretty.
As long as you're having fun, that's all that matters. Yes,
Exactly.
yes. But let's tell everyone how people can connect with you on social media, and then we'll just wrap it up.
Sure. Well, my website is familyfinancial.biz.
Hmm.
And so, if you are a business owner that has gotten to a point where you're writing six-figure checks, I mean, this is what we help with. And beyond that, I am on Facebook, Tammy Trenta, and LinkedIn, Tammy Trenta. And so you can find me. I'm out there.
Great, great. I will definitely leave all of those links in the show notes so people can just click on it and go straight to you, and get to know you and inquire your services. But thank you so much. And we definitely have to have you back on again because there's so many topics that we can have dealing with money and dealing with taxes, especially. Oh, because as we were talking, I was thinking of more things.
Yeah, yeah. And I know a big topic right now is real estate. So,
Yes.
if you ever decide to get around that topic, it's interesting. I could talk for another hour on just that alone.
That would be great because me and my husband, which I'm sure a lot of the listeners would love to hear that, as well as me, because me and my husband, we actually have started buying land, and it's just like, yeah, it's a whole different world.
Hmm.
It really is.
Certainly.
Yes, but thank you so much. We definitely have to have you back on again.
Sounds good. Thanks, Janice. Have a
You-
wonderful weekend.
You're welcome.
Okay.